If you own a condo in Southern California or you're planning to buy one anytime soon, pay close attention to what happens 5 days from now. A massive silent shift in federal funding rules is about to hit the California housing market, and it could literally wipe out 20 to 40% of your property value overnight. On August 3rd, 2026, Fannie Mae and Freddie Mac are permanently shutting down a shortcut that has led millions of people buy condos for decades without anyone taking a hard look at the building itself. After that date, almost every condo loan in the country goes through a full financial background check. Not you, the buyer, but the building. More than 500 California condo communities are already sitting on a list at Fannie Mae marked completely unavailable for financing. Hey everyone, I'm Hooman Morvarid, LA and San Fernando Valley condo expert with Hooman Real Estate. I've been tracking these regulatory updates line by line, and trust me, most homeowner associations and condo owners have absolutely no idea what's coming. Back on March 18th of this year, Fannie Mae and Freddie Mac put out a joint policy update called Lender Letter LL 2026-03. For as long as most of us have been buying real estate in California, there was a shortcut called limited review. If you put down 10 to 25%, the lender approved your loan mostly by looking at your credit and income, barely glancing at the building itself. That shortcut disappears for good on August 3rd. From that day forward, if a building has more than 10 units, every single loan has to go through a full review. The lender now has to audit the building's operating budget, reserve fund, insurance policy, HOA delinquency rates, pending lawsuits, and structural safety reports before approving a single dime. Now you might be asking yourself, why are banks suddenly treating California condo buildings like toxic assets? Here's the multi-million-dollar catch that nobody's talking about on the news. Beyond federal changes, California passed Senate Bill 326, known as the Balcony Law, which mandates that every homeowner association with 3 or more units must have a structural engineer inspect all exterior elevated elements like wood balconies, walkways, and stairways. On top of that, major SoCal submarkets from downtown Los Angeles to high-density San Fernando Valley corridors in Sherman Oaks, Encino, Studio City, Woodland Hills have strict mandatory soft-story seismic retrofit ordinances for older wood-frame buildings with tuck-under parking. When engineers peel back the stucco during these mandatory inspections, they're unearthing decades of hidden dry rot, water intrusions, and rusted support beams. Homeowner associations that spent 30 years keeping monthly dues artificially low by skipping reserve contributions can no longer hide it. To catch up, board members are being forced to hit owners with special assessments. One-time bills ranging from $30,000 to well over $150,000 per unit to fund structural balcony rebuilds, plumbing overhauls, and seismic retrofits. If you think special assessments sound nightmarish, wait until you see what's happening to monthly HOA dues right now. This next part is where property values are truly getting destroyed. At the same exact time structural bills are coming due, Southern California condos are getting slammed by an HOA master property insurance crisis. Major insurance carriers have been pulling out or non-renewing commercial policies across California. To maintain coverage, homeowner associations are being forced onto the California Fair Plan or non-admitted surplus lines carriers, causing master policy premiums to jump 100 to 300% in a single year. To pay these massive insurance spikes, an HOA has no choice but to raise the monthly dues by hundreds of dollars. We're seeing monthly fees in downtown LA high-rises and coastal complexes in Santa Monica, Marina del Rey, and Newport Beach, as well as major San Fernando Valley developments in Woodland Hills and Encino, jump from $600 a month to $1,200 to $1,500 a month. When Fannie Mae underwriters see an underfunded reserve account, unresolved balcony dry rot, or an incomplete master insurance policy, that building fails full review and gets labeled non-warrantable. That single label affects every owner in the building, whether they personally paid their dues on time or not. Here's the exact domino effect that traps condo sellers in escrow hell. And if you don't understand this math, you could lose thousands of dollars on your next transaction. A conventional loan only works if Fannie Mae and Freddie Mac is willing to purchase the loan from the bank. If your building fails review, Fannie Mae and Freddie Mac won't buy the loan, so the bank will no longer offer that loan to the buyers. That leaves only cash buyers or high-interest portfolio loans that require 20 to 30% down and higher interest rates. That knocks first-time buyers and working families completely out of the buyer pool. Shrink the buyer pool that dramatically, and seller list prices have to plummet to attract cash investors. Once a few units in the complex sell at those discounted prices, those lower sales become the official comps that appraisers use for every other unit in the building. In submarkets like downtown LA, median condo prices have slid nearly 20% as inventory sits. In Sherman Oaks, Encino, and coastal Orange County older complexes facing SB 326 repairs, we're seeing buyers walk away mid-escrow. So how do you protect yourself before this August 3rd deadline passes? Whether you're an HOA board member, a condo seller, or a buyer looking for a real deal instead of a money pit, here's your action plan. If you serve on a board, get your reserve study updated, complete your mandatory SB 326 balcony reports, and audit your master insurance policy immediately. Disorganized associations are already seeing escrow closings stretch from 30 days to 60 days or collapse completely. If you're a buyer, ask for the HOA questionnaire and the SB 326 inspection report, the reserve study, and the delinquency reports before you even write an offer. And if you're a seller trying to figure out if your building is warrantable, don't guess. Partner with a real estate team that understands the complex financial mechanics of non-warrantable condo lending. If you need expert guidance to navigate the Southern California market, reach out to me directly. I'm Hooman Morvarid with Hooman Real Estate, your trusted LA and San Fernando Valley condo expert. Thanks for watching. Reach out to Hooman Real Estate today, and let's make sure your next move is the best move.